What is reputational risk? A company can survive financial losses. It can survive operational disruptions. It can even survive economic slowdown. But once it loses trust, survival becomes difficult. Why do customers suddenly stop buying from a well-known brand? Why do investors sell shares immediately after a controversy? Why does one scandal wipe out years of reputation building? The answer lies in reputational risk. Reputational risk is invisible. You cannot see it on a balance sheet. But when it strikes, the impact can be immediate and severe. Let us understand what reputational risk really means and why it is so powerful. Reputational risk is the risk of financial loss or operational impact resulting from damage to an organization's public image or trust. It is not a direct financial risk. It is a consequence risk. For example, a compliance violation may trigger fines, but negative publicity may trigger customer withdrawal. That secondary impact is reputational risk. Reputation is built slowly through consistent performance, transparency, and reliability, but it can be damaged quickly through fraud, poor customer service, ethical failure, or even misinformation. In today's digital world, reputational damage spreads faster than ever. Social media amplifies everything. Trust, once lost, is difficult to rebuild. Reputational risk rarely appears on its own. It usually originates from another risk event: operational failure, compliance violation, fraud, data breach, product defect, leadership misconduct. Initially, the problem may be manageable internally, but when it becomes public, perception changes. Stakeholders react emotionally. Customers withdraw trust. Investors reassess exposure. Regulators increase scrutiny. Reputational risk is therefore a multiplier. It amplifies the impact of other risks. An operational mistake becomes a public relations crisis. A compliance issue becomes a trust crisis. And perception often moves faster than facts. Imagine a company facing a product quality issue. The direct cost may include recall expenses and compensation, but the indirect cost may be far larger. Customers may hesitate to buy again. Brand loyalty may decline. New customers may avoid the company entirely. Investors may fear long-term damage. Employees may feel uncertain. Reputational damage often affects multiple dimensions: revenue, capital, morale, and regulatory relationships. And unlike financial losses, which can be calculated, reputational damage is difficult to quantify. That is why reputation is considered one of the most valuable intangible assets. Reputational risk is dangerous for three main reasons. First, it spreads quickly. Information travels instantly across digital platforms. Second, it is difficult to reverse. Public perception does not change overnight. Third, it impacts long-term sustainability. Even if the financial loss is temporary, trust erosion can reduce competitive advantage. Reputation affects customer loyalty. It influences investor confidence. It shapes regulatory relationships. In highly regulated industries like banking and finance, reputational damage can lead to increased supervision and stricter compliance requirements. Trust is the foundation of financial systems. Without trust, institutions become fragile. So how do organizations manage reputational risk? First, strong governance and ethical culture. Preventing misconduct reduces exposure. Second, transparency. Clear communication during crisis prevents misinformation. Third, proactive monitoring. Tracking media sentiment and stakeholder feedback allows early response. Fourth, accountability. Quick corrective action restores confidence faster than denial. Reputational risk reminds us that trust is capital. It takes years to build, minutes to damage, and significant effort to restore. Financial strength is important. Operational efficiency is important. But long-term sustainability ultimately depends on credibility. Because in business, especially in finance, trust is everything. And protecting that trust is one of the most critical responsibilities of leadership.